Good afternoon, everyone. As you know, today we're going to cover the case for structural evolution in private equity. We'll learn about the growing need for a flexible ownership approach and the need for stronger long-term alignment between companies and sponsors. For those of you who don't know me, my name is Daniel Kirshner, and I'm the program chair for the CFA Society Ottawa. I'm particularly excited about this event as I just recently started my own career in private equity. I'm sure that many of you will be just as excited to hear from our guest speaker today. We've witnessed strong momentum in private equity markets recently, and the importance of the asset class only continues to grow. The event will be in a fireside chat format. Omar Medina will moderate the discussion with André Bourbonnais. The audience will be able to ask questions via the chat, and Omar will ask them at the end on your behalf. Please note that the event will be recorded and uploaded to our YouTube page. So a little bit about both of our guests. Mr. Bourbonnais is Managing Director and Global Head of Long-Term Private Capital at BlackRock. Andre brings 30 plus years of private market transaction and management experience. He was most recently CEO and CIO of PSB Investments, where he led all investment functions and presided over a rebuild of the firm's private market capabilities. Prior to that, he served as Senior Managing Director and Global Head of Private Investments at the Canada Pension Plan Investment Board, where he was responsible for over $65 billion in private market assets, the largest program of its kind globally. Over a nearly 10-year career at CPPIB, Andre built the firm's pioneering direct investing capabilities into one of the most respected in the world, while growing the private market investment team from fewer than 20 to over 230 professionals. Andre is an alumnus of the University of Ottawa and the London School of Economics. Mr. Medina is Director of Institutional Client Business at BlackRock. As a member of the US and Canada team within BlackRock's institutional client business, he is responsible for developing and maintaining relationships with the firm's institutional clients, including public and private pension plans, foundations, endowments, and insurance companies. Prior to joining BlackRock, Mr. Medina was a managing director with Manulife Investment Management, where he was responsible for developing new institutional relationships across Canada. Omar is an alumnus of Wilfrid Laurier University and Queen's University. He is also a CFA charter holder. Without further ado, Omar, the floor is yours.
Thank you so much for that terrific introduction, Daniel. And I'll add, I'm a proud CFA charter holder. Really appreciate the CFA Society Ottawa hosting today's discussion and partnering with BlackRock. Thank you. As private markets continue to scale, there's a growing need among both private companies and investors for greater flexibility of capital and stronger long-term alignment between companies and sponsors. Structural evolution is required to enable businesses to focus on the long term and to allow investors to hold on to winning companies. Today's discussion will focus on the evolution that we're seeing in private equity markets, the benefits of flexible and active ownership, underwriting, and of course, reflections on 2021. With that said, let's jump into the discussion. Andre, please tell us a little bit about your background. I know Daniel gave a great intro there, but before coming to BlackRock to lead long-term private capital, you were a lawyer, an investor, and then at the helm of one of the largest pension plans in Canada. Can you tell us a little bit about your journey? What was it like, and what role did private equity play?
Yeah, thanks, Omar, and really happy to do this fireside chat. Ottawa is a special place. I graduated from U of A, University of Ottawa, and so I wish I could be there in person. Although I hear these days there's a little bit of turmoil in the city. Listen, I hear sort of what Danielle said, and particularly focused on CPP, and to be honest, now I reflect on that, and going from 20 to 200 people, now the private investment group probably has over 400 people and twice the assets. So there's been tremendous growth even since I left. But my journey in private equity really started after my legal / corporate development career. in private practice and consulting and in the telecom industry. But in 2000, I joined CDPQ to run their financial services private equity group. And then after the collapse, the TMT group to sort of restructure it. And I really found something that I absolutely love. I probably shouldn't say that, but I hated every minute of being a lawyer. I just found the work very tedious, and I was not particularly a great legal mind, but I absolutely loved what my client were doing and finding out how they build their business and how they make money. So starting a career in private equity was quite interesting for me. And then I sort of grew up in it from CDPQ to CPP to PSP. And one of the things that I found, being in charge of such large pool of capital that needed to be deployed, was kind of the velocity of the transaction that we were facing. And once you get a certain scale, you get money back, either distribution from your sponsors, or you exit some of the transaction that you've done. So you're on this treadmill of just trying to deploy money while at the same time getting the fruit of what you seeded a few years back. So I've always thought that there was kind of a better model for private equity, and especially for long-term holder and people with long-term liabilities. And then so that's when it started really at CPP to sort of try to build a group that would align our holding with our liabilities, as opposed to be in the traditional private equity treadmill. Most of the pension plan in Canada are in the very fortunate position of being long cash but short human capital. So you kind of need to find your space and decide where you're going to play. And most of the pension plan in Canada that are really at the forefront of private equity, and I think are a model among the world. You always think or hear about the Canadian model. What they focus on is execution and governance, and they leave the very sort of human capital intensive aspect of transaction, like sourcing and value creation and exit, to partners. So I thought that if we could find transactions that maybe were less operationally intensive, that people at CPP could manage, but hold those deals for a much longer period of time, that would solve one of the issue that we had. And so at CPP, we did a number of transactions. When I was there, we did Wilton Re, which is an insurance company. We bought the Glencore agricultural business alongside with Glencore. As I was getting out the door, we were buying Antares, which is the credit business of GE. So there's definitely a room, but our bread and butter were still those large co-underwriting, co-sponsorship, alongside the sort of the usual name that you will hear in the business, KKR, Blackstone, CVC. When I went to PSP, I sort of did the same thing, but again, faced the same issue. So so for me, and believe me, being the CEO of one of the large Canadian pension plan is an incredible job. First of all, there's like 5 or 6 of those jobs. And second, you really feel that you're at the center of the Canadian economy, and then have an opportunity to develop that knowledge worldwide. But at some point, Larry Fink and Mark Wiseman approached me, and they say, we have this idea about doing something different in private equity. We think you're the guy to run it. Would you be interested? And it was a very, very, very difficult decision for me to move from being a client to sort of the dark side of asset management, of commercial asset management. But it was also at the same time a unique opportunity for me, and that's why I sort of decided to evolve my career in that direction.
Thank you, Andre. I mean, what an incredible response. I didn't think I'd get that much out of you so early, and really appreciate you sharing those perspectives. Obviously, the experiences that you had really acted as a big part of your decision-making process in terms of moving to BlackRock and looking to address some of the challenges that the private equity markets face. I'd love to hear a little bit more about how and why the private equity market structure has evolved over the last 5 years. Can you touch on that?
Yeah. So people are probably way too young in this room to understand this analogy, but I used to say that private equity was like The Young and the Restless. The Young and the Restless is this soap opera that has been going on I think, CBC or CBS since 1973. And I used to say, if you watch The Young and the Restless in the 80s and you sort of completely forget about it until the year 2000, you would switch it back and you sort of realize that it's the same people with the same plot, and it would only take you a few days to sort of get back in it, and realizing you have not missed much. And private equity was like that. It was sort of the same model over the 80s, the 90s, and big part of the 2000, and maybe also late in 2000. I think that, and it got probably worse, and I'm not doing private equity bashing here. I think there's a role for traditional private equity, but what happened after the crisis is that people were looking for yield, and it clearly wasn't there on the fixed income side. There was limited availability of public stock, and private equity really got into a boom era following the global financial crisis. So what happened is that during hard time, the LPs, and there's this incredible organization called ILPA, the International Limited Partner Association, that had gone and done tremendous work to sort of shift the power ever so slightly to the LPs. But from 2008 onward, there's so much demand that the power really shifted back to traditional private equity, and hard-fought gain in terms of terms and condition all but disappeared. So whether it was fee offset, key man clause that became so diluted that they were irrelevant, and a number of things that the LPs had negotiated, like hurdle rate, sort of disappeared. And now clearly there was a shift in the power. So, but I think that one of the things that over the last 5 years the private equity world has realized is that something that I think I realized a long time ago, but that there was a lot of value in, instead of sort of being in the moving business and trading in and out of your companies, to hold companies for a longer period of time. And we've seen all sorts of attempts to address that particular issue, some successful, some less successful. So there were a number of core funds, that essentially just extended the termination of the partnership. There were now those new extension funds that, interestingly, after 2008, was designed to own the bad asset of the private equity firm, but now seems to be a good home for the winners and extend the life cycle of those. But then again, those don't really address certain issues with traditional private equity, which means high leverage, fee leakage, and but it's certainly, I think, positive in terms of the LP, because it gives them a different option to own good companies for a longer period of time.
No, that's terrific. I would also assume it kind of opens up the universe a little bit in terms of companies that may be interested in that type of dialogue. I'd love to hear a little.
Although, as I said, I don't think it addresses certain key issues that are still there in those structure. And in order to address those, you kind of need a different, you kind of need a different mindset, a different pattern. And I hope that somehow we capture that when we launch LTPC. And I know I shouldn't sort of brag for my own team, but you know, there was a number of discussion that we had with our investors, with investor in general. From my experience, I think that led to sort of doing private equity differently, but giving the same performance to our investors.
So let's talk a little bit about doing private equity differently, and what you and your team are doing to kind of that fits in with that structural evolution that we're talking about, how it was created, and a little bit more details. We did get a question that popped up that you know, asked about fee leakage. I'll touch on that in the Q&A session, but maybe you can talk about fees as well, because I think that's really part of the overall puzzle.
Yeah, so I think that in order to do private equity differently, you need to start with a blank piece of paper. So it would be really, really difficult for traditional private equity. And again, there's absolutely a reason for traditional private equity to exist. But to start doing, you know, something different in terms of a fee structure, because they would have to rebase their existing business, which is like, you know, Bell Canada trying to launch a product that would be cheaper than their main product, and then everybody would migrate to that. So I think that you needed a blank piece of paper. You need to eliminate the conflicts also, because a number of the alternatives that I mentioned earlier were developed as part of the traditional private equity fund, and then a deal comes in, and you know, one track will generate more fees. So where do you send the deal? And if somebody passes on it, is it because it's a bad deal? Or so we need to, you know, we needed to really start from scratch. But for me, there were two elements that were absolutely critical. So first was permanent capital. And, you know, although some people have started to address that, I think and it's been done in other asset classes. I think that, you know, our part of the innovation here is really applying private or permanent capital to private equity. And what that allows you to do is not to have an expiration date on your holding, and being able to make decision as to keeping or selling companies based on the idiosyncrasies of the companies and not on an exogenous factor like I need to realize carry, I need to show realization to raise another fund, I'm getting to the expiration date of my fund, therefore I need to sell this company. So permanent capital addresses a lot of those issues. And the other was, you know, because I spent 20 years being a client and thinking that fees, you know, the sort of the allocation of economics, sorry. Sorry about that. The allocation of economics between the fund and the sponsor was really skewed to the sponsor. So having a more a fairer allocation of the alpha generated was kind of my priority. So while you're doing this, and those were absolutely two key. And what a more economic efficient model allows you to do is to underwrite companies with less risk, less volatility, higher conviction, but yet deliver the same kind of net returns to the investors. So, and that's, I think that that's the biggest part of the innovation. It's not lower fee to lower fee. It's lower fee that would allow you to do a better job at underwriting the deals that you're underwriting. So that is translated into less leverage, which certainly in a time where money costs zero and the returns in private equity have been incredible in the past, 10, 12 years. Certainly you kind of realize that when, in a interest rate or high interest rate environment, that may play a very different role. So, so that was really the basis, permanent capital and economic efficiency of the fund, that both led to a different way, an innovative way of deploying capital.
Can you touch a little bit on how the fund was created, or this approach was created? Obviously, you've got your insights from the plan sponsor side and your deep history on the private equity side, but it'd be great to kind of better understand how you came to where you are.
Yeah, so we had a straw man with some of the principle that I mentioned earlier. Clearly identified, but we said if we want people to buy in this new model, this innovative model, and I used to joke that everybody wants innovation until they realize it's never been done before. So we needed participation from our investors. So we reached out to 10 or 12 of the firm's best clients, some of them with very large private equity practice. And we said, here's the straw man, help us build something that you would find investable. And we're not going to write a PPM in a dark room and send it to a bunch of people and hope it sticks. We want you to, develop the product with us, for lack of a better term, and presumably be interested in investing in it. And so we started with 12 people. At the end, there were 4 people that were left, but the process took a long time, and you need to be patient, because you need to, it's hard enough to do it on your own if you have to make sure that 4 people agrees with you, very sophisticated people. It took a long time, but that's, I think that was part of the innovation. I don't know any other firm who brought their investors and say, hey, help us build something. So I think that was quite different, and that really allowed us to have a solid footing, and with those 4 cornerstone investor to launch the fund, and that's really how it started.
Thank you, André. I mean, I know evergreen funds are a little bit more common in other areas of private markets, less common in private equity, but I think that's only one piece of the puzzle, and engaging in a dialogue with investors to understand pain points really helps from an innovation perspective. Let's shift gears a little bit and talk about underwriting. Obviously, COVID threw a wrench in everybody's plans. Everyone went virtual. Things became much more difficult. Can you talk about your approach to underwriting and how it's changed since the onset of the pandemic? Has it affected the model or the way that you do business?
Yeah, so and you alluded to that, Omar, a little bit at the beginning, is that first of all, when I came to BlackRock, I had zero interest in doing the so-called 2 in 20 fund, because I don't think the world needs another one. But by doing something different, I wanted to offer something different to the investors, but also to the various companies that would be interested in some kind of private solution. So, and that was really, really key. So we started, and it wasn't easy. We put the whole team together by let's say September 2018, and by March 2020 everybody went home, and so we had very little time together, but we made it work, and we made it work because we had a very, very clear strategy. So we were not trying to be everything to everyone, and that's why I say, private equity has room. Like, I would not do what Apollo is doing. Apollo is doing very complex, sort of turnaround situation for the most part, where they try to buy cheap and, sort of rely on multiple expansion. Other, like, look at very high growth, like the Thoma Bravo of the world and the Vista of the world. So what we were trying to achieve really is to buy companies that were well established, like very high quality companies with a long track record, focus on growth, but growth at a reasonable pace. So we were not looking for the 30% a year kind of growth. We were looking at companies that would grow in the 3 to 7%, but also could grow externally, so by M&A, because we think that one of the value add of the team is our ability to buy companies. So if we could do it for our portfolio company, it's even much easier than trying to add companies to the main fund. So that's a big part of the underwriting. Obviously, we felt that our product appealed to a subset of the sellers or the companies. What we like is founder-led, private equity-owned companies that are a little bit tired of that treadmill and wanted to have a longer-term partner, wanted to have less leverage on their balance sheet, wanted less aggressive operational assumptions, so that if they didn't meet the plan in 2 years, they were still okay. So that one big subset of what we were trying. The second was family-owned companies that focus more on the partner as opposed to the last dollar. And lastly, corporate, who for the same reason are thinking more long-term about the partnership. If you look at how we've built a portfolio so far, that's how and where we've been successful. And so it's a different product that attracts people, but also the product attracts people that never thought they would sell to a financial buyer. Our second deal is a company called Creed, and Creed had been in the same family for 247 years.
Wow.
They didn't want, sorry. Didn't want to sell to their competition because they've been fighting them all their life. Didn't want to sell to traditional private equity because they knew they would flip them. So we were the perfect solution for them. So that's really how we underwrite. And as I said, because of lower leverage, because of less aggressive operating assumption that the economic efficiency of the fund allow us, we end up, underwriting higher conviction base case with all the upside that's still available, but deliver the same kind of net private equity return, as evidenced by the performance of the fund so far.
No, that's terrific, Andre. I love the Creed example. I mean, over 240 years in the family. I think that it's quite telling. And obviously, everyone familiar with the private equity space is also familiar with how companies can move from one portfolio to another, and you can see that movement. You brought up deals. Let's talk about deals a little bit. Let's dive into your direct deal experience. What was your most memorable private equity deal, and why? And feel free to give us a couple examples.
Yeah, I think my most memorable is a company called Skype that we bought from eBay, because and it would have never fit in our long-term plan. But here's a deal where there was a big issue, so we were able to buy it well. We knew how to fix it, and we knew who the buyer would be, and the thesis played out exactly as it was supposed to do. So we bought the company really well. We fixed the IP issue that there was in this, and 18 months later, we sold it to Microsoft for 4 times our money. So I could have retired after that deal. When you tell your partner this is what's going to happen and it happens, it was perfect. But example of deals that would have been absolutely perfect for a longer term hold. And there was this, I saw the question about fee leakage. So let me explain that a little bit, and I'll talk about Dollar General after. But the fee leakage is like, there's a company in the insurance space called Sedgwick. Sedgwick has been in the private equity world since 1989. It's been owned by 5 different private equity companies, from Stone Point to Carlyle to H&F. Anyway, huge success. It's an incredible company. But every time it was sold, the sponsor would clip their 20%. And strangely enough, big funds like CPP and PSP and ADIA and CalSTRS, they're usually in all of those funds. So every time they get their money back, less the 20% that you need to ship to your sponsor. And whether you like it or not, you reinvest in the new deal. And then if it's a success, it's being sold, you get your money back less than 20%. So over a period of time, and we've calculated that, sorry, 7-8 years is probably the right time period. I'm really sorry about that. It's super dry here. The impact on the multiple of capital because of that fee leakage is exponential. So if you own that company for, let's say, 12 years, you're going to make 6 times your money. If you're in that same company that's being sold 4 times, you're going to end up at 2.5 times your money. So a huge impact, and the IRR is going to be essentially the same, if that's important to you. So in 2000 and I think it's 2009, KKR approached us with Dollar General, and Dollar General is this fantastic company. It's like a dollar store, Dollarama here. I don't know if it's in Ontario, but incredibly performing company, national footprint in the US. And we did really well. We held it for 3 years, did 5 times our money. But then KKR said, well, this is like a winner. I need to show that to my investor for the next fund. And they decided to take the company public. We would have made 10, 12 times our money if we'd kept it until now. But because of some exogenous factor and the fact that we didn't control the exit, we had to sell. So that would be a perfect example of the company that you buy. Every now and then you review your thesis to make sure that it still works, that you can deliver the type of returns that you've showed to your investors, and you just keep on reinvesting, deleveraging, probably because the cash flow profile of that business was incredible. So that's really a good example. In other circumstances, we bought a company called ADTI. So we did this deal with Onyx, company called Thomson PLC. We bought Thomson, and Onyx's goal with Tompkins was really clear from the beginning. There's a company called Gates, a very sexy business. It makes the rubber belt for the engines, but it makes a lot of them. And Tompkins had a number of subsidiaries like bakeries and valves and air conditioning. And Onyx said, we're going to sell everything. We're going to keep Gates, and then we're going to either put it public or sell it to another financial sponsors. And they were true to their word. So we sold everything, and there were 2 units. Gates was left, and another company called ADTI. So I looked at the ADTI, and I thought there was still lots of runaway in ADTI. So sort of the mechanical aspect of HVAC, very well-run company, but Onyx said, no, we're selling this, we keep Gates. So we went to Onyx and said, okay, I know you don't like it, but we do, can we buy it from you? We made an offer, and we were the natural buyer because we knew the company really well. So we started on that path, and then 18 months later, company, Johnson Control, met the CEO, and he said, you own ADTI? Yeah. So I want to buy it. I need it. Okay. How much are you willing to pay? And the price they were willing to pay was like way above anything that we, even on an organic basis, we could have created in terms of value. So we decided to accept. So you need to be flexible, but if you have an opportunity to own a company for a very long time, you should do it.
Yeah, no, I love that. Thank you for sharing those examples. There's always, I guess, a reason to sell if it's good enough, but being able to have the flexibility to hold is really the value proposition with permanent capital. I'm curious, where does permanent capital kind of fit with traditional private equity? Could you maybe touch on that a little bit?
Yeah, so at the beginning, and to be honest, we weren't very good at trying to figure out where it should go with our clients, and we should have probably spent a little bit more time. So some people put it in their private equity bucket, other people put it in their so-called like special situation / innovation / special deal. But we always believed that it belonged to private equity. And I think that what we see now is that it's migrating towards private equity. For those who didn't put it in private equity in the first place, they're migrating it to their private equity. Now, institutions are still very siloed, so they like that something fits right squarely in something. I never believe in that theory. When I was at PSP, we had this deal Vantage that was a data center, and so it went to infrastructure first, and the guy in infrastructure said, well, no, there's too much commercial risk, but I really like the deal. So I took it to the private equity guys and said, well, they own the real estate. That's really a real estate deal. So I'm not going to do it, but it's a really good deal. And then I took it to the real estate guy. I said, well, it's commercial, like the real estate is not the driver here. So, but they liked the deal. So I took the three heads of my group. I said, listen to me, you're all telling me this is a great deal, but we're not going to do it. So I think you need to find a home for stuff like this. The more avant-garde institution like Ontario Teachers, this sort of eliminated the wall between private and public equity. So it's all equity. I think they see private equity as leverage equity. But I think that for lack of a better home, it clearly belongs in private equity right now.
Yeah, no, thank you, Andre. I think whenever you've got, an evolution or innovation taking place, it takes time to kind of figure out some of the finer details. Let's kind of wrap up the discussion before we jump into some questions on reflections on 2021. Would love to hear your feedback on the market. What surprised you, both good and bad, and what do you see moving forward?
Yeah, so, ever since I started to do private equity, I have earned too much money chasing too few deals, and yet the private equity world is still growing and growing. And I think that that will continue. And I think that a number of companies are much better suited for the private market than the public market. What we've seen, and I will admit that I'm completely biased on that. What we've seen, I think, in the last year is sort of a bit of the fear of missing out. So first of all, for certain sector like tech, you needed a lot of guts to invest, because 30 seems to be the new 20 in terms of multiple. It's very, very competitive. Another space that is hugely competitive, and some of it is genuine, some of it is a bit of greenwashing, is ESG. We looked at 3 ESG consulting company and were completely blown out of the water by the prices that were paid by our competitors on that. And what we've seen is very short, truncated processes where people just after the first round, they'll come on top and preempt the bids, and we've been on the losing end of so many of those, just because people felt that they needed to own something, that even if the diligence was approximate, they still went for it. So I think that has been that with the multiple have been the two major situation that we've experienced last year. Fortunately, we're not a high volume business, so we need to do 1 to 2 deals a year and 3 deals. But it's got to be utterly frustrating for people that need volume to be in this market.
Thank you, Andre. We got a question from John. Just curious, can you talk a little bit to when a permanent capital solution like long-term private capital would actually sell a business? I mean, you gave the example of ADTI where you got paid more than you thought you would. I think those opportunities are few and far between. So would love to hear your thoughts.
Yeah, so that's a clear example where we are fiduciary for other people's money. It's not our money, and when somebody comes to you with an offer that breaks your model, essentially, that you don't see that you can create that much value by holding the company even in a longer space, that's when you need to act. The other element is if a company is so successful that for portfolio construction reason, and I wouldn't say sell it completely, but you need to right size it, that would be a reason why we would sell, either partially or as a whole. And the last one is, we're not going to get 100% of the deals right, and our thesis will evolve, will change. Disruption may happen in the market, and at some point, as we re-underwrite our original thesis over time, we may realize that we're not going to be able to deliver the returns that we've represented to our investors, and that is really key. That if you don't think that you can create the value, then you need another solution.
Thank you. I'm curious, with inflationary pressures and rising rates, how have they impacted valuations in the private equity market generally? Yeah,
so I'm kind of bullish on that, in the sense that interest rate will go up, but if you look historically, even if they go up by 2 points, we're still going to be in a relatively low interest rate environment. So I don't think that it's going to break the house. I don't think it's going to affect the value the same way the global financial crisis affected the value. So people got in trouble in 2008 just because there was no growth, and they had levered the businesses to the gill. We own a company that we were offered 7.5 times leverage on it. It's currently sitting at 3.5 times, and we're very happy with that, getting into this sort of unknown environment. And we have a number of businesses that are sort of protection against inflation, lots of businesses with recurring revenues and sort of necessary goods without being consumer staple. So certainly from our point of view, we feel pretty good, but I don't think that the inflation and or the raise in interest rate will create a major opportunities, and I think that everybody thinks it's going to be temporary, maybe 2 to 3 years, but still. So people will weather the storm and find a way out at the other end of this.
Thank you, Andre. I mean, one of the things that I appreciate most about you is how candid you are, and I think that was shown in a lot of the discussion today. You're a leader in this field. You have such a depth of experience and knowledge, and I think what is most telling is the fact that you left PSP to start from scratch, because you had that conviction in being able to solve a very complicated issue along with your team and everyone else that helped collaborate along the way.
It was like I've got great partners, a fantastic team that I would pin against any private equity team in the world. But you're right about conviction. We absolutely needed it, because it was not a smooth ride all the way to where we are right now.
I know we're running up against time, but there's one more question that just came in. Maybe you can take a minute to talk about your thoughts. But what opportunities do you see in climate, ESG, if any, and in the emerging markets?
So I don't like to talk about stuff that I don't know. So I'll tell you, I'm pretty novice in terms of emerging market, and our fund is focused on North America and Western Europe, because the type of deals that we're doing is there. Although we have companies, I mentioned Creed. So Creed, which is eye and fragrance, people who've spent any time in Asia know how much they love their brand. So, big market there, and we'll open up there. But in terms of transaction, this is not really a home for us. So the other opportunity in climate, I think, so we take it into, if you want to do long-term investments, sustainability is absolutely key, and sustainability of the business model is key. We're more traditionalist in the sense that we looked at areas and sector that have produced returns and excess returns in private equity. So financial services, technology, healthcare, and business services. There's other pocket of money within BlackRock that is more suited for benefiting from the climate, from the climate opportunities. Let's call it that way. If you read Mark Carney once in a while, you will see that he thinks that this is probably the best investment opportunity. We tried to do it, but we tried to do it indirectly. We spent a lot of time looking at insurance companies. So clearly that's one of the sector that's going to be hugely impacted by climate. Providing or creating areas of concern, but also providing great opportunities. We look at a number of data analytics companies that would probably at some point be a major player in terms of providing data to various industry, whether it's chemical or other industrial that are impacted by climate change. But we don't have a very narrow view of those opportunities.
Thank you, Andre. With that said, I'll pass it back to you, Daniel, to wrap up today's session. But really appreciate the time and the dialogue, Andre. Thank you.
Yeah, it was a pleasure, and like I said, I really enjoyed. Thanks for moderating. I much rather this format than the 25-minute long speeches.
No, I agree. And Daniel, thank you for hosting today. I know you've got a couple comments to wrap things up.
Yeah, no, for sure. Thank you both, Andre, Omar. Kind of really appreciate the discussion. I certainly learned a couple of things myself. I think it was interesting kind of how you noted kind of the emergence of the ILPA kind of post 08 and how it sort of helped LPs and then sort of positions us to where we are now in the context that, maybe LPs might not have, kind of as much power, and maybe there is maybe some room for kind of a new private equity approach. So I think it was definitely interesting to learn about kind of the less aggressive approach, kind of longer investment horizon, and how you can still generate compelling returns if you have high conviction opportunities. So it was fantastic to learn from you, Andre. It was a pleasure to have you here with us today. So thank you both once again on behalf of the CFA Society Ottawa for joining us. This is just a quick housekeeping note to the audience. So as I mentioned earlier, there will be a recording of this event on the Society's YouTube page. We also have past recordings of events there as well. And then, of course, I highly encourage you to continue to monitor Society's event page and our LinkedIn for any upcoming events. So just quick note here, March 10, there's a presentation on active currency management. March 17, there's a presentation on behavioral investing, and that's in partnership with the CFA Society of Edmonton. And then maybe more importantly, we have the annual forecast dinner coming up on April 14. That's with Stephen Polaz as our keynote speaker, so that should be a good one. So anyway, thanks again for joining us, and have a good rest of your day, everyone.
Thank you. Thank you for having me.